Welcome to Value Investing webinar. Today I have a very special guest, Ajit Dayal of Quantum Asset Management, the founder and a director. And what better occasion than the kind of turbulence we see here. I'm going to ask him a set of questions: how to invest, value investing in turbulent times, and what greater turbulence we can see today. So Ajit, might I straight away get on to the questions that this crisis seems to be an unprecedented one, which by its inherent nature could not have been predicted by anyone, the scale and magnitude and the breadth of it. So with its effect on people and business and more broadly on the increasing complex global economy, how do you think this will, your guess in terms of how things are going to pan out for the world economy, Indian economy and Indian business and your funds? Two bigger questions.
Sure. So, firstly, thank you for having me and great to see you and hope everyone is safe, everyone watching too. It is a time to be very careful for sure. And, I would never have said these words in any other situation. So clearly we are in a very different environment compared to where we were, a few months ago. But I think from a market perspective and an economy perspective, since the great financial crisis of 2008, I would argue that this was the most expected bear market. Everyone expected the market to come down. Everyone expected the economy to stall, global economies. And no one knew what the reason was. They were unsure whether it was student loan in the US. They were unsure whether it would be a Eurozone implosion or Brexit or a China hard landing. No one assumed that a virus which is 1/50th or 1/80th, depending on the diameter, on the thickness of your hair, but a very small virus would result in all of this. So that, I think, is the thing, that no one expected a virus to do this, and no one expected the global economy to shut down the way it has. And, a lot of where we stand today is because of either default or conscious policy-making decisions. Mm-hmm. And I would argue that the global economy would not have to be shut down if you had built, and this is a very startling statistic, if you had built more hospital beds in the world. So the reason we're shutting down the global economy is because doctors are saying that as patients come to hospitals, we don't have beds for them, right? So this is spreading everywhere. It's whatever RO factor or the spread factor is far greater than a normal flu that we get every year. So it's spreading everywhere. And because it's spreading everywhere, people are under threat. So one stat that I worked out, roughly speaking, is that there have been some 85% increase in general in McDonald's in the world from 2008 till now, in Starbucks, in Pizza Huts, in KFCs. So consumerism and consumption has increased dramatically. The Chinese who never traveled and Indians who never traveled much before 2008 are traveling a lot more. So we do have a globalized economy. Now, if we had invested, for argument's sake, in something like 300,000 hospital beds around the world, right? Or 500,000 hospital beds around the world, you would not have necessarily had this problem the way it is. People would have said, fine, this virus is spreading. If you fall ill, I have a hospital bed, I have ventilators, and I can take care of you. So honestly, the fact that the number of hospital beds per 1,000 people has declined by 20% in Italy, 22% in Spain, 25% in other OECD countries. So the average OECD countries from 2008 till now have seen a decline per capita in hospital beds and seen a sharp increase in restaurants, cafeterias, places to have coffee. So that's why we closed down the economy. A $30 billion, my estimate, loss of investment in hospital beds has resulted in trillions of dollars, maybe $10 trillion of economic, damage. That's a policy choice that we've had. And even in India, I mean, as we speak, shamefully, the BMC, the Maharashtra government, and Larsen and Toubro are spending 20,000 crores. They're still on the construction site today in a lockdown on a coastal road, when that 20,000 crores or 18,000 crores, whatever they've not spent, could be used to build hospital beds. So policy choices need to be made, and individuals need to realize that it's our fault. We've gone along this consumption pattern and kind of not looked at the health pattern. So I think the problems are with this pandemic is you've had a much more integrated global economy. China was consuming very little in 2008. It's a huge consumer of oil, semiconductor chips, everything, you name it, cars in the world. They account for anywhere between 1/3 to 1/2 of global production or consumption of a whole host of items. Compared to SARS in 2002-3, it was very, very small, 5%, 8% kind of numbers. So that's increased. 40 million Chinese tourists traveling around the world, 4 or 5 million Indians going around the world. All that has stopped. And in global economic terms, tourism and related functions like restaurants, hotels, etc., accounts for about 15%, 1/5 of global GDP, and probably 20-25% of global labor force is involved in tourism or tourism-related activities. So this is big. This is very big compared to what we've seen.
Getting back to the nuts and bolts of the business we are in, or you are in, the quality of business, a key tenet of value investing and your funds. We have been looking at it very closely, talking to your fund managers every month, and our interaction with them very closely just reinforces that they're so focused on quality. And that has been on the forefront of your funds, and that was also the driving force behind the recent market. The sustained market, the segment which was sustaining well. So,
Right.
What are the key measures, according to you, that could help a value investor determine quality in a business, the quality in a business in the current situation? How do you go about choosing companies now, while the fragility is so visible and coming from unexpected points?
Yeah. So, clearly, but firstly, I have to make a confession on behalf of any value investor out there and value fund manager like Quantum has been. So even though I left the board of Quantum in 2017, I still sit on the investment committee and I kind of watch the decisions that are made that are going on to build the portfolios. But I think value investors in general have had a terrible last few years. So if you look at the Quantum long-term equity value fund, its performance has been pathetic, to say the least, in the last 16, 18 months. And if I go back to 2014 May, that's the time when Prime Minister Modi won the first historic mandate, followed by a mandate again in 2019. But from May 2014 till recently, till the market peak, literally 3 stocks accounted for 66% of the gain in the indices. I look at the BSE 30 more than I look at NSE 50, so that dates me in terms of what kind of investor I am. But basic HDFC Bank accounted for about 28% or 26%, I think, of the total gain. Reliance was 18%, and HDFC was 18%. So literally 3 stocks did far better. And these are kind of expensive stocks to some extent, or they have certain things in them which not every value investor may like. And so a lot of the gain that's happened in the indices has been the momentum, the growth story. Kind of don't look at India 1 quarter ahead, look at India on a 5-year view or a 10-year view. And money has moved to what people perceive as quality. So our perception of quality as a value investor is clearly you got to have great management with a good product and a very strong balance sheet. And of course, valuation criteria play a strong thing. So even though, for example, HDFC Bank may qualify, the valuation would not. Now we've seen, for example, HDFC Bank and other stocks, the valuation numbers have come within the valuation criteria or the value criteria for groups like Quantum Long-Term Equity Value Fund. So after many, sorry?
They are reasonably priced now, even by your yardstick.
They're reasonably priced now. I mean, the prices have collapsed, the valuations have collapsed compared to what they were just a few months ago. And, so it's a great time for us to continue to see that in the existing portfolio, which companies have those 3 criteria and which companies now have come in the valuation criteria. So obviously what we have, we like, and there are some stocks that we liked, but we could not afford to buy them as a value investor. And they've now, become buys. So there's a reshuffle going on in the portfolio. There's a reallocation going on, and more companies are entering the portfolio some of the weights that we have, even though we still like the companies, we think, fine, we can reduce a weight here, release cash to invest in the other companies that we never had. But the three key criteria of good management, of great management, I would say, good product and strong balance sheet, that is a very, very strong criteria. Very few of the portfolio companies we have will have debt. Of course, banks have debt, finance companies have debt. That's their business. They borrow and lend high. But in the operating companies and the manufacturing or service companies, very few companies we have will have debt. And that to us, we don't know when this is going to end. So companies must have a strong balance sheet. Those that have a strong balance sheet will emerge stronger. And there may be fewer companies left whenever the cycle ends again.
This crisis can linger, I don't know what anybody can really put a time frame to how long will it last, or, when will we see a degree of normalcy. So, what effect it will have, against this backdrop, some of the value funds have been a test of patience for Indian investors, and suddenly this collapse. What kind of time frame do you have in mind, which will, which one should have for these investments to be very productive?
So, I'll give you I'll give you two answers to this. One, of course, what I referred to was policy. So, for example, Maharashtra, which is a state with one of the highest, affected places. So, if Maharashtra was to, for example, announce that we're going to cancel our stupid idea of a coastal road, 20,000 crores is going to be saved. And yes, we may have 50,000 cars stuck in more traffic as they use this because there is no coastal road. Maharashtra alone will be able to build 2 lakh hospital beds. So if you build 2 lakh hospital beds, the chance of saving someone's life who gets COVID is extremely high. I mean, please recognize that for 95%, as the stats show, of people who get COVID-19, it's like a cold and a cough and fever. I have asthma, so I am more susceptible for something going wrong. Hence, I need a hospital bed with a ventilator. So if there are enough hospital beds, society can remain open and we can, begin our normal work very quickly. But because we're spending money on projects that don't make sense, like the coastal road, for example, in Bombay, or maybe in Delhi, trying to build new, parliament buildings or whatever we're doing. But if policy response moved very quickly, then I would say there is a finite timeline. I don't care whether you have a vaccination or not. You give me ventilators, you give me hospital beds, we have a finite time. On the other side of the equation, like now we're waiting for someone globally most likely to come up with a vaccination for this. So by all indications, by June, July, August of 2021, there will be a vaccination. So your outer limit of a COVID-19 is the vaccination release in June, July 2021. So you could suffer this for a whole year. There are people who are hoping that as the summer season begins in India and in the Western world, in the Northern Hemisphere, then the virus will die, just like SARS. So it's a spin-off apparently of the SARS virus. So I'm not a doctor, but I'm a doctor's son. That still makes me a quack. So I'm not giving you any medical theories up in what I read. So, if this is like the SARS, and I was in China the day SARS was declared a pandemic. I was literally on a train from Guangdong to Hong Kong, and I could see people with face masks when I got off the train in Hong Kong. But if you actually believe the theory that heat kills the virus, then it's got a short span life of a couple of months, and then it'll kind of fade away. You'll still get some infections, for sure. You'll still get some, sadly, so you'll get people dying, but it won't be the fear that you've got today. And it will be a lot calmer, I think, in a few months. But the damage to the economy could be for a long time, for a long, long time. And that's another whole discussion that we can have.
In one of your recent blogs, you pitched the idea of bringing a law for companies to build a cash reserve for rainy days, such as the one now. But can you elaborate on this argument supporting the idea? Doesn't this interfere with the principle of free market economy, more so in India, where the governments actually go about dictating things? It has been mandated for companies to have a CSR fund.
Yeah, so CSR is very different. I think there's two. So let's go rewind back in history. Till the 1980s, banks, but particularly European banks, and insurance companies, particularly European insurance companies, never truly revealed their reserves. They used to all have a hidden reserve. I remember HSBC, that's been listed for decades, had a hidden reserve, and no one knew what the true book value of the bank was, because every year they would keep aside some money, and that hidden reserve would obviously grow, and people would estimate. You knew how much was going away, and then you don't know what it was earning, so you'd keep on assuming a certain number. Now, as we became more oriented towards an MBA driven and a CFA driven return on capital employed, show me efficiency of your capital, it became unfashionable for companies to sit on high hoards of cash doing nothing in safety reserves. So companies like HSBC, the European insurers, all began to pay out or declare the hidden reserves. And now they all run on this minimum, whatever the Basel norm is, or the IRDA norm maybe for insurance companies in India. They all run capital based on this minimum style to be the most efficient, use of capital. And that efficiency causes problems like this. Because if, for example, and I did some numbers on this, if Indian companies from 2009, about 180 companies we looked at, if Indian companies had kept aside roughly 20% of their profit after tax in a hidden reserve for a rainy day, most of them today would be able to pay between 6 months to 12 months of their salaries and wages without a problem. They would have had that reserve. And we did the other calculation. What would this have cost those Indian companies? I mean, something like $8 billion, right? So if you had actually kept $8 billion of sort of dividends aside in a hidden reserve, chances are, you would not have had a $200 billion loss in market cap. So now you work out as an investor. Do you mind if your companies kept 8 billion away and given that less to you and kept in a hidden reserve? And now you would have faced maybe a $200 billion market cap. Sure, markets would have come down, but would they have really fallen? Markets today are frightened. Do companies have cash? Do they have liquidity? Lack of liquidity, liquidity could result in some cases to bankruptcies, to insolvency in the case of finance companies. So that's the fear of the market today. You see how the banking stocks are moving. But if everyone had kept aside something for a rainy day, you would have to go to the government with a begging bowl. You would be able to stand on your own feet. And by the way, Quantum has been following this. We have about, I think it's 20 something months of cash reserves, assuming we have zero revenue. So we lose all our clients, and we have to keep everyone paid and still pay all the rents for office space that we don't really realize we need anymore, but still pay our rents. We can last for more than a year and a half, nearly 2 years. So, I think if companies had built that buffer, so I'm not saying capitalism is bad. I'm saying capitalism that became extra smart, capitalism that was built for this efficiency when there is no black swan event. We've had so many black swan events. Asian crisis, well, before that, LTCM, Asian crisis, tech bubble, 9/11, SARS. We've had the global financial crisis now. So every 5-6 years, there's something going wrong. Just plan for it. Keep this money aside. And if governments don't do it voluntarily, make a law.
Yeah,
in my view.
Because capitalism in its current configuration is bound to remain petty. It is unlikely to get generous till we have a law.
Yeah. And sorry, it goes back to the kind of definition of a company, which now people are realizing. So, I did my MBA in the 1980s, and that's about when Reagan came to power, Thatcher was in power, and this desire for capitalism to replace communism, socialism, kind of grew exponentially after that. And financial markets grew, kind of became much more focused on being more efficient. And so all the theories of finance that people followed really happened around the late 70s and early 80s and took off from there. And one of the tenets of companies prior to that, even in India, I mean, if you went to a Jamshedpur to see a Tata Steel factory, or you went to Renukot to see a Hindalco factory, which I used to visit decades ago when I first started doing research, and they ran everything, right? They ran the township, they built the temples, they built the mosque, they built the church, they built the water supply, they built the school, they built the hospital, they built the movie theaters. There was no PVR multiplex in those days and no Netflix at home. But that's what they did. They looked after the entire community. And somewhere down the line, and that was the Russian model, if you want to call it that, or the European model, not so much the American model. And as we modernized, as we became more US centric, as we became more capital market oriented, and your return on equity, return on capital, you kind of forgot about two other very important parts of a three-steg rule. We focused only on profits. And as the saying goes, there are two other important P's. There is the people and there are the planet that you have to worry about. And so now companies will pollute if they can save money. Companies will shortchange their staff if they can save money and show higher profit. So the whole nature of capitalism, what we call capitalism, did not exist prior to the 1980s. Capitalism prior to 1980 was a much more superior form from a holistic perspective. This may be more efficient from a stock market perspective, but then if it is, then please don't go to the government to rescue you. Accept the bankruptcy of the companies you're invested in because you've been stupid about it as an investor. And that again takes you to the other theory that, or the other fact that there's been a divorce between the shareholders' interest and the management's interest and the community's interest or the staff interest. Complete divorce in this new capitalism. So in my view, it really has to change big time.
Maybe these are opportunity, these are inflection points where a lot of thinking will go towards all this. The way we used to conduct ourselves and the way we are conducting now.
True.
Getting on to another petty, not petty, but something which is crucial for an individual investor. What changes in terms of asset allocation should one consider at current times? What should an individual do? Considering the current market drawdown, this has been, you have seen a couple of earlier declines.
Yes.
Has this been the fastest one of this magnitude?
This has been the fastest. I think it's been, well, actually in post-Lehman in 2008, we lost about 50% of the market in 5 weeks, right? So we haven't quite got to 50% yet, but we're nearly there. In dollar terms, for sure, we've already gotten there because we've also lost a bit of currency. But in Indian rupee terms, we lost 50% in 5 weeks, and the currency fell by about 25% in 6 months at that point in time, when we haven't got there either. So I think, to put it in perspective, this has not been as bad as the Lehman crisis as yet. Could it get there? Maybe, I don't know, but it's not been as bad. And I think from an asset allocation perspective, I remember in 2008, I wrote an article that I'm taking my family for a holiday, and someone got upset and they wrote to me saying, "How dare you take your family for a holiday when the world is in a mess?" This is before the green shoots of March 2009, and everyone is suffering. And I said, "Hey, I planned my life that way." So just like in Quantum as a company, we built a reserve so that we can survive and do well for 2.5 years without any revenue, still pay costs. In a very similar way, I tell people that keep aside money, your monthly expenditure. Let's say your expenditure is 1 lakh a month as a household. Keep aside, that's what I do, 24 lakhs to 36 lakhs. So 2 to 3 years of your monthly money requirements, you keep it aside. And the rest of the money, what I've been doing is 80% in equity funds and 20% in gold. I'm a big gold bug, as some people may know. So I do that breakup. And then, of course, because I'm more of a value investor, I have a bigger chunk. Sadly, bad mistake, bad allocation. I have more of my 80% of equity in Quantum Long-Term Value Fund than I have in Quantum Equity Fund of Funds or the newer Quantum ESG Fund. So, but I tell investors that, so look, if you're not a value person and you're neutral to how you want the market to grow or to increase, then I actually suggest that they do a flip. They have 80% of their money in the Quantum Equity Fund of Funds, and of the 18 equity, they have 10 in the Quantum Long-Term Value and 10 in our new Quantum ESG, and then, the 20% in gold. So this money that you kept for 2 years or 3 years, 3 months of that money can be in a savings bank account or in a current bank account, and that's fine. The other money I've been keeping in a liquid fund. So I think liquid funds, the chance of your FD being frozen or your bank account being frozen is zero. It's not going to happen. So and the Quantum Liquid Fund and a few other liquid funds, the ones that only buy government paper, where there's no private sector risk. There's no Tata, there's no Birla, there's no Ambani, there's no Adani, nothing. No private credit risk at all. So you're just buying government paper and taking government risk. You take less risk, you earn less return. But this 24-month money is not to earn return, it's to give you peace of mind. So if I know that that a vaccine will come by August 2021, I've got enough money just to continue spending my monthly expenditures the way it is. I'm sleeping well every single night. And the other part of my portfolio is going all up and down and getting whacked by the market. But it'll come back, and I'm reallocating when I can within that portfolio. So that's a principle that I followed. And some people think that's too extreme, that's too conservative. I say, okay, keep 6 months of money, keep 9 months of money, but you must have enough money safe, kept away, which looks after your monthly expenditure.
Years.
And the rest of it, what I've done is 80-20 split.
And 20% in gold. Gold has been such a drag, if you look at long-term returns of gold. So tell me about your fascination for gold and such a high allocation.
So, I have a desire to travel. So when I travel, as many of us do, or we have kids who travel or go to university or whatever, they want to go outside India or travel. And that's a dollar cost. It's a foreign exchange cost. And if I look at the Indian rupee from 1966, when we effectively went off the silver gold standard after we had a crisis in 1966, we've lost about nearly 3% per annum compounded from 1966 till now. And the only Indian asset that I can buy, which is really priced off an international US dollar base, is gold. So I can legally hold gold, and gold is dollars. So depending on when you look at your start point, you can argue that gold given you a 4% return in rupees or a 5% return in dollars, right? It depends on your start point of it. I'm fine. Like I said, this is to offset the continuous depreciation of the Indian rupee. And it's not going to stop. Not because India's a bad economy, it's because, it's poor economy right now, but India's a growing economy. Growing economies require foreign capital. Whenever you're an importer of capital, you effectively have a weak currency. So you will have a depreciation in the long run. The rupee may be steady for a while, may look very good, but then something will happen like this and it'll go. In 2013, August, September, the rupee crossed 60s, 665, 66 rupees. When Prime Minister Modi won the election in May 2014, the rupee went to 52. So the rupee became strong from 60s to 52. And look at it now, from 52 to 76 plus in the last 6 years. So on average, forgetting what happens between every regime of a prime minister, the rupee is bound to continue to depreciate, in my view. Gold, I also like gold for another reason, because around the world, central banks and now governments have been spending a huge amount of money, which they've been printing out of thin air. And I'm a monetarist, if you want to call me that to some extent, or a gold bug, call me what you want. But I believe that, so from August 15th, 1975, when President Nixon August 15th, 1971, when President Nixon took the US dollar off the gold standard, the US dollar has lost about 98% of its value against gold. The US dollar has lost 98%. And the Indian rupee has lost another 90% or 80, 85% between 1971, August 15, and today. So it depends on when you tell me you're looking at the start of gold to get this 4% rate or 3% rate. I would argue if you had bought gold in 1971 in Indian rupees, you'd probably be earning 8-9% by now, just sitting on it. And it's your insurance. That to me is a big thing. So I'm a believer of gold. And as governments step up to rescue the economy worldwide, which they need to, that'll lead to fiscal deficits. Fiscal deficits again lead to more printing. So you have more paper floating around the world with less gold to substantiate. Gold is a currency. Everyone loves Warren Buffett. He's a value investor, like us, and we look up to him a lot. But the one disagreement we have with him is on this. He says, rightfully so, he says gold is something you dig, you pick up from the ground, and then you dig again to store in the ground. So what's the use of it? Warren Buffett is right in the physical attributes that I dig and I put it back. But he's totally wrong because he's lived in America. Till now, America has had no crisis. Ask George Soros, ask any other investor who's lived in Eastern Europe, Russia, China, India, Brazil, Argentina. Ask them what is the one thing that they faithfully believe in, and it's gold. So we all live in economies that are not, on the solid footing.
Migrants.
And therefore gold comes into place.
I know people in Delhi, who were migrants at the time of partition. The people who are rich and who are not so rich, the difference was that some had gold. And
exactly.
But the form in which you actually hold it today, is it the form which will actually hold the value?
Yeah, because the way you have notes, how do you have currency notes? I have some in my wallet, I have some in my cupboard, and I have some in the bank, and I have some in liquid fund, right? In some sense, it's all currency, it's all rupees. So gold is the same thing. People wear gold, right? Especially the poor people, they wear it around the neck or they wear it on their fingers. That's their insurance. That's their cash. That's their currency. Kid falls ill, you pawn off the gold, get the money, and you pay the hospital bills. But and an individual can allocate gold should do the same. Have whatever's allowed on your body or on your cupboard. Have what you cannot have in a vault. So either you buy the gold and go to a bank and keep it there, or you give it to, for example, Quantum Fund and other funds are out there. You give it to them, and there's an ETF or a fund. They buy the gold in wholesale, so they're paying less of a spread than you would if you went to a retail jeweler shop to buy gold. You'd pay a higher spread. Because they're buying in wholesale, there's a lower spread compared to wholesale prices, but there's a cost. There's an institutional cost of paying for example, Chirag's salary. It's not free. There's a whole operations team that calculates the NAV. There is Brinks, who looks after the security of the gold. There's Deutsche Bank, who keeps the gold in a vault. So there's a chain that you pay for, but that entire chain costs 0.25, 0.5%. I mean, and you have no headache of wondering whether you can access your bank or if the gold in the cupboard is going to get stolen by someone or not. So it's there. So it's paper, but it's reflecting the value of gold. And to me, it's shocking that people haven't been buying more of gold in India. And they're still keeping it in bars or wearing it around their neck. I mean, to me, that's insane. That is the best way to do it.
After the Modi government came, we have a new instrument, which is sovereign gold bonds. And it's doing the same thing with little extra. But then it carries the sovereign, of course, you have to trust the sovereign guarantee.
Exactly. So that's the thing. You're buying gold because you don't trust the government. I'm not saying this government is not trustworthy. Don't get me wrong. In fact, when India did issue gold bonds, decades ago, we honored them. India came back and gave gold for gold bonds. I think it happened in the mid 1990s. I can't remember my year, but that's when India came gold for gold, gave you back the gold. So that was a big thing. People were nervous because the price of gold had risen some 30, 40 times between when they took the gold from you and when they had to pay it back, but they gave it back through SBI. So, so it's not that you're buying gold as an insurance, and you're buying it because governments, sovereigns have to print money and rescue economies. So why would you take a sovereign bond? That doesn't make any sense. That's no insurance. It doesn't make any sense at all. You have to get something which is away from the sovereign. We are at the end. The most important questions. Value funds have been struggling. And, in India, we had the categorization mandated by SEBI. This has been a very struggling category among the equity fund. We also had an interaction with their fund managers, asking about, their struggle and why they have been a laggard. Is it due to any fundamental change because of the reclassification, or, what can value investor expect from here on? This is the most specific question. Correct. So we are not a value fund because SEBI gave us a classification. We were born as Quantum Long-Term Equity Fund and now Quantum Long-Term Equity Value Fund with the value process. And it so now happens that there are 16 or 15 other people occupying that value slot. So that doesn't make a difference to us what SEBI does or what others do. But I will say this, the value process that Quantum has been following for decades We have an audited track record from the parent company, the sponsor company, going back to June 1999. So, 20 years, nearly, actually, sorry, June 2000. I apologize. So it'll be 20 years in June. So the process has broken. Something has gone wrong. So in a value style, what should you do? When markets go up, the value fund initially should do better than the market because you probably got good companies. And at some point in time, as markets get frothy, the value manager is selling and getting off the bus and holding cash. And cash doesn't go up in a rising market. Cash is cash. So if you're 80% invested and the markets have risen by 10%, well, you've got an 8% ride. Your other 20 has done nothing. It's cash, right? In a very similar way, when markets fall down from the peak, because you're holding high cash, only 80% of the portfolio should fall down, say 10% with the market. So you should be losing 8%. And your 20% cash doesn't fall. It doesn't lose value. It's protecting your value. In the last 16 months, we've had a couple of mini cycles. Keeping this one aside, we've had 2 mini cycles. And we found that our value process was not protecting on the downside. Of course, it did make us sell as markets were rising. So we underperformed on the upside, which is what we're meant to do. But when markets come down, we're supposed to hold capital and preserve capital relative to the peer group around us, or to all mutual funds around us. Forget the value funds, but all funds around us. And it's broken and it's not working. And we're trying to figure out what in the environment has changed. What do we need to tweak our portfolio construction? We're still value managers. We're still in the value process by disciplined value stocks. We're not going to change who we are. But the portfolio construction process may need to be changed because, as I mentioned, when you look at this index-driven market, when you look at foreigners buying an ETF outside, an emerging market ETF or an Asian Pacific ETF, they're literally buying a few stocks. And it's those 3 stocks, as I mentioned, HDFC, Reliance, HDFC Bank, Reliance, HDFC, which have driven much of the gains. And if you have only one of those 3 stocks, Reliance is a stock we're never likely to own because we have a lot of issues with the corporate governance of Reliance. But, we would like buy HDFC Bank and HDFC, but one was expensive. So we didn't own it. So you're going to underperform. So is it because the world has changed and we are now doomed that even on the downside, right, we will fall more because those stocks are likely to fall less than much of the market, in the downturn. They're more liquid, so they'll fall more initially. But because they're good quality and good managements, HDFC Bank and HDFC, or Lever or whatever, people will go back and buy those stocks. So do we have downside protection only for a few days, but not for a few weeks, as the markets, tend to go back and buy good quality? So we're trying to figure out what can we do on the portfolio construction process to negate this indexing that's going on in the world. Or do we just remain who we are and declare to the world, like, look, we're buying value stocks. There's less risk in the companies. But from a price performance perspective, we're not going to give you any outsized returns over cycles as we've done since 2000 because the cycle of the downturn is no longer giving us protection. So that's what we've been studying for the last 6-8 months. Don't have answers to it, but to be honest, that's what we've been looking at very harshly from our side.
One last question. In the middle of this crisis, any tactical change that you have brought about, or have you been able to drive in your portfolio or in a direction?
So the only thing that happened, we typically had between 25 to 35, 40 stocks in the portfolio. We were at the lower end of that because markets were expensive till Jan 14th, 2020. But obviously with markets correcting, there's more opportunities today. And so the number of stocks has increased. From a sector allocation perspective, we were high in financials and we were high in automobiles. And if you think about the fact, an automobile stock is sort of a financial stock because 80-90% of all automobile sales are financed. So if there is a problem in the NBFC sector, if there's a problem in the banking sector, the movement of money to someone to buy a car, even if they want to buy a car or buy a two-wheeler, gets impacted, either the movement, either the quantity of money, the availability of money, or the price of the money. So if you really think about it, there was not an unintended, we knew about this. We had taken a 45% bet, if you will, in financials in a broad sense. If you count the true financials and you count companies that are relying on easy finance to get their business done. And we kind of said, okay, is that a risk we're willing to take? And the answer was yeah, because we're value guys. We go where there's value. So we don't have any sort of, macro, we have a macro perspective of India. End of the day, we want to buy good companies with very good products that people can sell. People will still buy cars in India. People are going to buy two-wheelers in India. So there's a whack. But if those companies are solid and if they have good cash in the balance sheet, we should be buying more of them right now, which is what we're doing. We're adding to that. So we haven't got a strategic shift. We've actually got a reinforcement of our ideas that companies with strong balance sheets, products that people are going to buy, and managements who understand their business are the ones that we should be in. So it's reinforcing what we've already done.
Thank you, Ajit, for your time and sharing your perspective. Wishing you very best.
Yeah, thank you very much, and stay safe, and hopefully we can see each other in person much quickly. Then this is interesting, but meeting in person is always more fun. So thank you very much.
Thanks.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.